Okay, well, Jahangir Aziz is now joining us. He's head of emerging markets economics research at JPMorgan. Jahangir, good to have you with us here. Thank you very much for your time. By the way, as we are coming to you, Jahangir, I don't know if you saw, but incoming President Trump has posted on the social media platform Truth Social. He's saying that, well, there is the Internal Revenue Service in the US collecting taxes from Americans. He's going to create the External Revenue Service. It's going to come alive on the 20th of January, responsible for keeping tabs on tariffs and who owes how much to Americans, and essentially, a collection agency from the outside for the outside world. Yeah, I mean, I began by saying that maybe one should. It's kind of what we're seeing now, and till the 20th of January is kind of peak Trump, and things perhaps will settle down once he actually is in office. Is that too much of a stretch to expect, Jahangir, or you think it's possible?
Look, the way we are looking at we've been tracking this since, the election was over. And, it is possible that President Trump comes out to be very different from his rhetoric during the campaign. I'm neither brave nor imaginative enough to try and second guess President Trump. So we are taking him literally. And as far as taking him literally is concerned, we think that the tariffs and immigration will be changed dramatically. And then later on, both tax policies and deregulation. So on tariffs, our view is that China and Malaysia and Vietnam, through which Chinese transshipment goes through, will be targeted. We had 60% tariff on China, so China and tariff is 20% at present. We expected it to go to 60%. Why 60%? That's because President Trump, during his campaign, mentioned 60% several times. As I said, we are going to take him literally, and not try and second guess. I think the news reports, etc., that has come since the election suggests that that may not be the only objective of the tariffs. Tariffs could also be driven by the objective of raising revenue, such that the tax cuts that he is proposing can be funded. Now, if that's the case, then our sense is that on January 20th or that week of 20th, you're probably going to get many, many more countries under the tariff umbrella than just China and Malaysia and Vietnam.
Okay, Jahangir. So we just one thing. Jahangir, you're saying that Chinese imports will be tariffed at 60%. I just wanted to make that clear.
That's a baseline. That's a baseline. Its current effective rate is 20%. We expect 20% to go to 60%. But as I said, that was our view back probably in December. I think the news flow since December suggests that perhaps it may not be 60%, maybe a tad less, but many other countries will be brought under that tariff umbrella. So tariff will be imposed on many of the countries, simply because that's the only way in which you can actually raise any reasonable revenue.
And you're saying other countries may also see these countries, especially from where China was using as points from where to send things into the US to avoid this tariff, right? Mexico, etc.
That was Malaysia, Vietnam. So this is going to be, our suspicion is that if you're going to raise revenues, you have to now impose tariffs on countries which were seen to be alternatives to China. You need to block that off. And therefore, many more countries will be brought under the element.
So Jahangir, I mean, I'm hearing you loud and clear. You're not in the camp that's expecting, this will ease out, and maybe it's all been rhetoric and more a bark than a bite. Take your point, take your caution on board. But my question is that hasn't much of this, even if it plays out literally as what he's been saying, hasn't this been priced into the market with the dollar rushing to 110? I mean, have we already seen the worst of the market interpretation and the mayhem?
Really?
There's more to go.
You can at best take dollar euro, for example, or DXY. You at best can get about 6-7% of tariffs being priced in. That's it.
Oh.
6-7% of tariffs is, I mean, any kind of FX arithmetic, if you break it down between the growth differential between US and the rest of the world, the interest rate differential, even after, especially after the change in the Fed call that we have done after the non-farm payroll came out last week, if you take those two factors, which are the usual drivers of dollar strength, at best you can say that the market is pricing in maybe 6-7% of tariff increase. That's the extreme.
Ooh.
The 6-7% tariff increase on what? On China?
No. The average effective
tariff increase.
Tariff increase by the US. So the tariff right now is about 2.3%, right?
I see.
So 2.3%, you add about 6-7%. That's about all that the dollar is pricing in this point in time. It could easily be significantly larger than that.
This is scary, but we need to understand, the full import of what you're saying, Jahangir. So you're saying average tariffs are 2.3%. The markets are right now with the dollar at 110, they've priced in maybe 6 to 7% increase. So China may be at 60%. What is the average overall increase that you're expecting, taking him literally, taking Donald Trump at face value at what he's been saying? And how much more than for the dollar to go? 115 more? The DXY.
You can easily add another 10 to 20% tariffs on the rest of the world. So 10 to 20% tariff on the rest of the world, that's the number that he's talked about, along with maybe not 60% of tariff on China, maybe slightly less tariff on China. That could well be what we see in next week.
Okay.
So what does it mean for the dollar then? The DXY?
I don't think any of my strategists are willing to price that.
Okay.
See, all right.
These are scary numbers. So, obviously,
I can imagine.
Indeed. Let's look home at our own currency then. The Indian rupee has weakened. We are at around that 86, 87 odd. Many were projecting by the end of this year we'll be at 87, 88. We're already there. We're 15 days into the calendar year. What happens to the Indian rupee? If you could, tell us how do you see that move? And also, what are you pricing in with regard to the RBI, Jahangir? Because earlier we were factoring that maybe in February we see some kind of action, which could get pushed back a little bit. Your take?
Yes. So I think, there are two parts to it, right? The one part of it is that the real effective exchange in India has gone up significantly over the last 2 years. So there is the need for the exchange rate to depreciate in order to bring back the real exchange rate back to more normal levels. So that's one driver of that. Obviously, oil prices, current account deficit, etc., are the other driver. The outflow of foreign portfolio outflows is the other driver. But I think that in the event we do get these kinds of tariffs being imposed, we really don't know what it is. If you go literally by what President Trump has said, it is going to be a pretty large number of pretty high rate on the rest of the world as well as on China. So it would what happens in the Indian rupee depends almost entirely how dollar CNY reacts. If dollar CNY reacts by, let's say, depreciating another 5% or more from here onwards, then the rupee is appreciated even more against its biggest trading partner, which means the real effective exchange rate gets appreciated even further, making the need for a nominal depreciation even that much greater. Therefore, the pressure on the rupee to depreciate becomes even greater.
Right.
Look, I won't be able to tell you what the number is, but the direction, that is the direction of travel.
So, if tariffs on Chinese imports are not 60, but even 40, whatever, dollar CNY goes to 8, and then currency here in India, which also, I think, as you say, depreciates, right? Will have to.
That's correct.
So, just a couple of things I wanted to clarify, Jahangir, if you can. One is, there was a report which said that, there was no pushback to it. Usually, press reports something and Trump tweets or something and says, well, this is all rubbish. But there was this report which said that gradual tariff increases, not at one go. If that were to, so far, 48 hours, we've not seen any pushback. If that were the way it is implemented, do you think that is more desirable?
Look, it depends on what is the objective, right? If the objective is, I'm going to use euphemism over here, to improve U.S. competitiveness, right? Then you can talk about a gradual increase in tariffs. You negotiate things from the other side so that U.S. competitiveness, quote unquote, improves, right? If that's the sole reason, which was the reason as to why we said only China and the transshipments through Vietnam and Malaysia would be targeted. But if the objective is to raise revenue, then then there is no real negotiation, right? Then there is no reason for you to have a, sliding scale. You want $250 billion of tariffs. U.S. imports is about 3.6 trillion. To get that, you need a tariff rate pretty much around that, 8, 9, 10% rate. And I'm talking about the average effective tariff. Now, how you distribute that across China, across other countries, that's a matter of choice.
Got it. Now, let's talk about impact on, say, tariffs go up. So average tariffs on imports into US is 2.3%. You're saying that goes up to what in your base case?
So we don't have that. We do not have a baseline where we say, we just had a baseline which says that only China will be targeted. The risk is it's going to be far more extreme than that.
Okay. What is the, so I'm just trying to see what's the feed through to inflation? And then
on the US,
on the rest of the world. US inflation, what happens to
the interest rates
in the US?
Right. So you're asking a very difficult question. Okay, let's start with the first question: inflation. In order to minimize the impact of inflation, chances are that whatever increase they have, this universal tariff increase, is not going to be uniform across all goods. Consumer goods, the tariff will be less. Intermediate goods, the tariffs will be much higher. So in order to get, let's say, a 10% average effective rate. That minimizes your impact on inflation. So that's the way we think it will be played out, if indeed you're getting a universal tariff. It's not going to be uniform 10% on everything. Consumer goods less, intermediate goods more. So I think that's such a move can, at least in the first rounds, before the second round effects take place, that can minimize or limit the amount of increase on inflation in the US.
So pragmatic, pragmatic in that sense, Jahangir, at least in terms of effects on inflation, US inflation.
Right.
Just to complete that point, what does the Fed do then? Rate cut bets have disappeared. Is there a chance that there could be a rate hike, or you think that's extremely unlikely? One of your
we think the rate hike is extremely unlikely. You really need the core PCE to move above 3 and remain there and things like that, which looks unlikely. On the other hand, we have already taken out all rate cuts for the first half of the year. We just have 2 more rate cuts, one in June, the other in September, and that's it. So that the terminal rate is 4. Not too long ago, we were talking about terminal rates around 3. This was probably 3 months back. So there has been a significant shift. Now, what does the Fed do? If you look at the minutes of the December meeting and the median SEP, there is already in December itself, there was already a sense that the Fed members the FOMC members were already looking at the impact of these tariff increases, immigration. We didn't even talk about immigration, which could be another hit on inflation, already there. So just to give you a sense, if you look at the SEP in 2025 raised growth just by 0.1, 2 to 2.1.
Sure.
They reduced unemployment just by 0.1, 4.3 to 4.2, and raised inflation almost about 0.5.
Jahangir, so now I'm coming to whether, we've seen some sort of, at least a near-term peak in the US 10 year, whether a lot of this has been priced in the fact that it will only get, at best, 2 rate cuts, like you're saying, maybe not a rate hike, but at least 2 rate cuts. Whether the US 10 year has priced, and then very quickly a move on India, because everyone's trying to second guess now what the RBI will do here, given the external environment and our local issues. I mean, we had an inflation print that came down, CPI inflation, but look at what crude is doing. It raced away 5% thanks to these sanctions. So just quickly, your expectations on the US 10 year, as well as the path ahead for the RBI.
So on the US 10 year, I think the business cycle part of it has already been priced in, i.e. that the Fed is only going to go at best to 4, and that you're not really going to get a rate cut more than 2 rate cuts for the rest of the year. I think that part has been priced in. What has not been priced in is the impact of tariff on inflation, the impact on immigration on inflation, and more importantly, the size of the tax cuts and therefore the size of the fiscal deficit. Those haven't been pressed. So I think that if you have, negative shocks on those three things, you could see the 10-year move up, and 10-year has been moving up.
Yeah.
So that's on the 10-year. On India, look, very quickly, we have been arguing about a rate cut for a long time, given that we had expected the growth to slow down significantly, inflation to come down. Core inflation already has been languishing for a very long time. So there is no reason not to have a rate cut. We do have a rate cut in February, and we're still sticking with that there will be a rate cut in February. Obviously, if there is a turmoil in the FX market, then the rate cut gets pushed off. So far, I don't think a 3% depreciation is enough to take away that rate cut. But a depreciation higher than that, yeah, possibly the February rate cut gets pushed up. But we do have a rate cut in February. In fact, we have 100 basis points of rate cut in 2025 price for the RBI.
Got it.
Wow.
Got it.
100 basis points rate cut by the RBI, irrespective of further currency in 25.
In 2020.
And the average depreciation the rupee has done in the last many years is about 3%. Given what you described on tariffs on the dollar, you're baking in 100 basis points of rate cut with how much rupee depreciation in India this year?
Probably another 2% if we don't have very bad tariffs. You have very bad tariffs and you have dollar CNY moving if dollar CNY moves very dramatically, obviously those calculations are off. Again, the basis in which we are calling for these rate cuts is simply because the economy is going to slow quite appreciably, as will inflation.
Jahangir, just one last, very, very quickly. India does not export too much to the US. Services is another matter, doesn't import too much. It's relatively insulated, right? A second order, third order effects aside, all these tariffs, etc., which you say could be draconian, India remains a little sort of insulated in that sense?
Again, it depends entirely on what China does. If you go back to 2018-19, China lost a significant amount of market share in the US. And China recouped all of that lost market share by moving into emerging Asia and Latin America. If that playbook is repeated, we could again see China do exactly the same thing. And in that event, in order for that not to happen, I think India will probably need to think about not just FX policy, but things even beyond that.
Got it. All right. It's a very, very good conversation, Jahangir, and you've sort of patiently laid out many, many, many points, and I'm going to go back and hear it again. So thank you very much.
And hopefully I'm completely wrong on Jahangir.
Well, we'll see. And yeah, from a market point of view here in India, we do expect that you are wrong. But let's see. We'll find out. And hope to hear more from you over the next couple of days, because it's going to be fast moving and lots of news flow, etc. So it would be lovely to have that perspective. We'll take